Hi James, thanks for joining me today and welcome aboard.
Hi Luke.
So as the newest addition to the JCB team, can you maybe kick off with giving us a bit of a background on your experience in bond markets to date?
Sure, thanks for having me Luke. So I began my bond market journey back at ANZ, started there as a graduate almost 15 years ago, and I worked Melbourne via Sydney via London, where we were pricing offshore markets, so dealing Aussie, Kiwi, European rates, US rates, and then moved back in 2014 where I joined a local fund manager, Victorian Funds Management Corporation, VFMC, where I managed the internal bond portfolios, and then about 3 or 4 months ago moved across to JCB.
Okay, so turning to markets now, it's certainly been a rocky start to 2022, and bond markets have obviously been at the heart of some of that volatility with central bankers turning to more hawkish stance. If we look locally first, the RBA is probably a little bit further behind the pack in terms of where they are in reducing stimulus. What was your take on the RBA board meeting last week and some of the comments that came out of that?
Yeah, that's right, Luke. So I guess to begin with, we're at a position in global markets where we talk about different central banks having divergence in that they're going in different directions and different. We're looking at opportunities in the way that markets are going to operate this year. But really what's happening is it's all converging. And what that means is rates are going one way, and that's higher. So what happened at the RBA last week is they began the next steps towards their policy normalisation, which means they've started talking about rate hikes, which may now happen towards the end of this year. They talked about unwinding their balance sheet, which has been at extremely accommodative measures, which effectively stopped QE as at the February meeting, so that they have their last bond buying program this week, and then they'll start to unwind the balance sheet later in the year. So we also got a bit of extra information. So Governor Lowe, RBA Governor Lowe, also spoke at the National Press Club, and he talked about what it meant to have sustained inflation, and he actually loosened up the term. So we always thought it was 2.5 in the middle of a 2 to 3% range for inflation, and wages wanting to see a 3% handle. But what he actually did was walk that back and talked about looking at some of the softer data points. So things like chatting to businesses. Business liaisons are a big part of what the RBA do. So getting information on what they're doing about wages, seeing bonuses, how they're being paid, looking at some of the ABS payroll numbers. And so by understanding that, not that it gives more clarity, but allows us to understand how the RBA is going to behave this year and how we can react to that.
Yeah, and interestingly, the markets really moved quite aggressively ahead of the RBA's own forecast, and I think we're now pricing in multiple rate hikes just for this calendar year alone. What's JCB's outlook for or view on valuations across the curve at the moment?
So I guess if you just go back to the start of 2022, it's been a really interesting year for bond rates. So we opened up with the Federal Reserve, the FOMC, the US Fed, looking a lot more hawkish than the market had been expecting. So more hawkish meaning they noted really tight labour, inflation numbers have been higher, we're now pricing in a much steeper rate hike curve in the US. And what's happened this year following that is that the Australian bond market has actually moved 1-for-1 with the US bond market. So right now, and I was just looking at my desk before, if you look at the 10-year yield in US Treasuries, which is the global rate of risk-free, the global risk-free rate as the market looks at it. So that has sold off, so gone higher in yield 44.5 basis points since January 1. The Australian 10-year bond has gone 45 basis points. So it's literally 1-for-1 when you've got this divergence of policy so far, where the RBA's said that they want to be patient and they're looking through and want to see get more information and more inflation prints, more job numbers, whereas the US is more likely to be hiking rates as of next month. So how do we look at that? Well, on a pure valuation sense, Australian bonds do look like they've oversold and got fairly cheap and quite attractive at an absolute yield level. But what we do know is that we're in a global pool of capital, and Australia needs to have that little bit of a discount, so it needs to be a little bit cheaper to make it more attractive to offshore buyers rather than holding the risk-free rate of US Treasuries. And that's why we can continue to potentially underperform US rates.
So looking further abroad, you mentioned the Fed a few times. They've really been quite vocal in terms of bringing forward expectations of policy normalisation. You suggested that potentially we're looking at a rate hike in March. What's your expectation for Fed policy throughout the rest of 2022?
So the key metrics that the Fed is looking at this year will be the Fed funds rate and will be the unwinding of their balance sheet that's become extremely bloated over the last 2 years of extreme policy. So what we do expect is that seeing the most recent CPI number was a 7%, which is the highest rate since the early 1980s. We've got the jobs number at 4% or thereabouts, which is effectively full employment. There's no way that a central bank in their right mind can keep rates at extreme policies as they are right now. So we see the Fed beginning their rate hiking cycle for the first time in about 3 years with a March rate hike. The market's actually potentially pricing in a 50 basis point hike. We don't think that they'll go that far. And then we'd expect to see in the order of 5 rate hikes over the rest of the year in the last 7 meetings. There's actually every chance that they could do 7 rate hikes with the level of inflation right now versus the jobs number and versus how accommodative we are. On top of this, we expect them to start unwinding their balance sheet. That will happen where they reduce the amount of bond buying they're doing to the point that they start letting it roll off towards later in the year. Now, this in itself is going to have large impacts on risk markets potentially. At no stage in history have we seen such an unwinding of accommodative policy. We've got a huge balance sheet that needs to be unwound, plus the unwinding of the zero interest rate policy. And we think that in itself will create volatility through the year and will create opportunities as well.
Yeah, and so on top of that, we're also likely to see one of the biggest fiscal contractions in modern history as governments globally start removing some of those emergency spending packages. Do you think that investors are paying enough attention to that change, and what do you think might be some of the shorter and medium term impacts?
So I think you've got to think about what's happened with these fiscal spending. It's come in different ways. You've had, which was the Federal Reserve and global central banks everywhere in their bond buying programs. You've had stimulus checks going direct to the consumer. This money's being put into assets, so it's being put into stock markets, it's being put into housing markets, it's being put into retail, and so it was something that central banks needed to do in the situation we've seen. Unwinding this, there's been tens of trillions of dollars of stimulus put through the market, like extraordinary amounts, and so what's going to happen is there has to be a slowdown. How quick that'll happen and how that'll come through in markets is probably yet to be decided. Even the most recent earnings season in the US has seen in the order of 75% of companies beat their expectations. So that means earnings are still going okay. The world hasn't stopped, but we haven't actually seen the full stimulus withdrawn, and we're still at extremely stimulatory levels of rates and liquidity. So when that does slow down, only time will tell, but it's not going to be positive for risk markets. We've already seen as the Fed has become more hawkish, we saw a massive drawdown in equities in January and February. Tech stocks, so the Nasdaq was down in the order of 15 to 17% at one stage. S&P 500 was down about 10%. Locally, the Australian equity market was in the order of 8% down, and that has bounced back a bit in time. But the market hasn't seen in the last 10 years that sort of withdrawal of liquidity and rate hikes. So I think credit markets may see a bit of a shift towards more neutral from being heavily overweight as the year goes on.
Yeah. I mean, we certainly can't have a conversation without discussing inflation. So globally, inflation's continuing to sort of heat up. We're starting to see that trickle into wages now as well. What's JCB's outlook for inflation and labour markets in 2022?
Yeah, sure. You're right, Luke. Inflation is at extreme levels. Like as I mentioned a minute ago, we're talking 1980s. The last time we saw inflation here, US inflation at 7%, European inflation's at 5%, New Zealand inflation's at almost 6%. Australian inflation is a lot lower, so it's about 2.5%, but we have various reasons for that. It's a quarterly review. We have different products in there. For example, US inflation includes things like used cars, which are, they've soared as we haven't been able to get new pieces. We've had supply chain issues, which has been dominant globally. The zero COVID policy in China has added to inflation because they are and will probably continue to be the engine room of manufacturing for the world. And so if they shut down, it means things just can't get made. We're short of different parts, they're not getting assembled, shipping containers are in short supply. So what does that mean for the rest of the year? Well, it will stay high for a little bit. Where it will settle, will US inflation get back to 2% by the end of the year? Probably not. But what's going to happen is we will see supply chains open up a bit, and we're starting to see that a little bit now. So we've gone through a period where, I don't know about you, but I've just been buying stuff. I haven't been able to do stuff, so I've been buying stuff. And I've been sitting at home and looking out my window and seeing the lady next door get her FedEx and her AusPost and a delivery every day. And I just know that's where people are spending money. We haven't been able to go to restaurants. We haven't been able to go to the cinemas. So there's just experience we haven't been able to do. In time, as Omicron has come, and hopefully we've seen the peak of that, and it seems to not be having such a huge economic effect globally. I think that level will sort of even out. So we'll go back to doing things, having fun. Hope we can one day, Luke. But what does that mean? We look at different data points like the Baltic Dry Index, which is a shipping index, and that's come from extreme levels back to sort of a more level playing field. When you look at that means that these supply chains are really starting to unwind a little, like the issues that we've been seeing. So in time, I think inflation can potentially keep rising a bit, but then the other thing about inflation is base effect. So the actual inflation number that you see is the rate of change of inflation. So, oil's a big part of inflation numbers. If that goes from $40 to $80, that's a 100% increase. If it goes from $80 to $120, it's actually only a 50% increase. I say only, it's still going to hurt you when you fill up your fancy car. But what that does mean is that it does peter out at time. And so we're going from prices at one level to a reset of prices. So sure, it'll be more expensive, but the way the maths works, it just can't keep on going up forever.
Yeah. Well, I'm on a first name basis with my local AusPost delivery guy now, thanks to the wife and kids. So certainly understand where you're coming from.
Thanks, Barry.
Correct. I did want to touch on credit markets as well, because they've been surprisingly benign in recent months, despite the volatility we've seen elsewhere. What's your take on how credit markets are behaving? And are there any sort of looming risks out there that you're sort of wary of at the moment?
Yeah, sure. So interestingly, with a lot of the credit markets, the way they make up the indices is, like you say, they've been quite benign and very well behaved. One thing to think about, especially in the junk bond index, is that there's a lot of energy producers in there. So what we've seen in the last, especially since the start of the year, with oil up in the order of sort of 20%, natural gas up in the order of 30% year to date, is that those energy producers are actually doing really well, because they're making a lot of money from you and I, but it is what it is. So that's actually kept junk bond spreads really low. You might remember a few years ago when oil crashed and credit markets went wider, because again, it's led by the energy producers. Now that's not a total story of the whole credit market, but what it does mean is that part of the complex is staying cheap. Now, what will happen to credit markets? Look, in time, and we saw this in 2017, we saw this in 2008, when the Fed start hiking rates and through these big cycles, credit does start to crack. You get to a point where, why would I own a BBB bond at, call it 3%, when I can own a US Treasury at 2.5%? It just doesn't make sense. So you might as well be getting the government rated, fully guaranteed, risk-free yield, and then you need to have credit yields repriced to take all that in. So as we say, they've behaved very well so far. The rates market and the rates complex is often the front of this locomotive of risk markets, and rates make up, and global bond yields make up a lot of the reason of where global markets are where they are. Cheap money, discount rates make everything look cheap, investment. But once they do go up, it can really change the story quite quickly. And I'll tell you what, when that changes, the door to get out can get very small very quickly.
Yeah, interesting. I think we can probably all agree that this sort of heightened volatility is here with us. Well, it's going to be with us for the foreseeable future as people adjust to this next phase of the cycle. How are you and the team managing risk in your portfolios in an environment like this?
Well, I think to begin with, you have to be nimble and you have to be humble. We're coming into a world, where we've lost a non-price sensitive buyer in the US Fed, and the RBA is going to do the same, and the ECB at some point will do the same, that you're actually losing that player in the market, which means prices can and most likely will reset to a point. And that's when you find the global pool of capital will reprice and you will get a level. But that means you've got, like we were saying, credit's going to struggle to find a bit of a buyer, equities might get hurt. It's not going to be a straight line. And so what we do try and do as with the team on the desk is make sure we're disciplined. That's the key to it. So I don't think this year you need to take huge punts. We all expect, well, we do expect that rates will be higher in the complex, but at some point you find that terminal level and rates can come lower, and that there'll be opportunity to really load up on duration, looking for lower bond yields. So what are we looking at? We're looking at different parts of the supply chain, how that's going to turn around. Very close eye on inflation, very close eye on wages, and how they're going to turn. Obviously, we keep a very close eye on risk markets as well. But the key will be not to fall in love with the position, because in the we talk about the divergence of different asset classes. It's going to create opportunities, and so we want to have enough capital and dry powder to be able to take meaningful positions when that happens. But for now, and probably for the next couple of months, I think there's going to be enough volatility where we don't need to throw the kitchen sink.
Yeah. Well, thanks again for your time, James. It's been really insightful, and I'm looking forward to speaking with you further throughout the year.
Thanks, Luke.